Imagine two people. Both earn decent money, both decide they want to invest for their future. But one of them starts at 20 years old, and the other waits until 30. That 10-year difference might not sound like a big deal, but in the world of investing, those 10 years can mean the difference between hundreds of thousands of dollars or even millions. And that's because of one powerful force that quietly shapes almost every financial success story in America: compound growth. Let's break this down in a way that actually reflects real life in the United States. Imagine someone named Alex. Alex graduates college at 22, lands a decent job, and decides to start investing early. Nothing crazy, no day trading, no risky bets, just simple, consistent investing. Alex invests $300 a month into a basic index fund that tracks the U.S. stock market, like an S&P 500 fund. Historically, the U.S. stock market has averaged about 7 to 10% annually over long periods. Let's be conservative and assume 8% per year. Now, imagine Alex keeps doing this every month. No trying to time the market, no panic selling during downturns, just steady, boring investing. By the time Alex reaches age 60, those monthly contributions could grow to well over $900,000. Not because Alex invested huge amounts of money, but because Alex gave the investments time. Now let's look at someone else. Meet Jordan. Jordan also wants financial security. Jordan works hard, pays bills, and enjoys life in their 20s. But investing feels like something that can wait. There are student loans, rent is expensive, maybe a car payment, maybe traveling, social life, or simply figuring life out. So Jordan waits until 30 to start investing. Once Jordan turns 30, they decide to be responsible and start doing the same thing Alex did. Jordan also invests $300 a month. Same fund, same 8% average return. But here's the difference. Jordan has 10 fewer years for compound growth. By the time Jordan reaches age 60, the total investment might grow to around $450,000 to $500,000. Still a lot of money, but compared to Alex, it's roughly half. And the shocking part is this: Jordan didn't invest less each month. They didn't choose worse investments. They simply started later. This is the power of time in the market. Every year you delay investing, your future money loses years of compound growth. And compounding doesn't grow in a straight line. It grows exponentially. In the early years, it feels slow. Your account grows, but not dramatically. But over time, the growth starts accelerating. Your money begins earning returns. Then those returns start earning their own returns. That's when compounding really starts working. Think of it like a snowball rolling down a hill. At first, the snowball is small. It moves slowly. But as it rolls, it gathers more snow. It gets bigger, and suddenly the growth becomes massive. Investing works the same way. When you start at 20, your snowball has decades to grow. When you start at 30, the hill becomes shorter. And here's something important that many people misunderstand. Starting at 30 is not too late. This is a huge misconception. Many people believe that if they didn't start investing in their early 20s, they've somehow missed the opportunity. That's simply not true. Starting at 30 is still incredibly powerful compared to starting at 40 or 50. The key difference is that later starters may need to do one of three things: invest more money each month, work a few extra years, or adjust expectations for retirement. But even then, the most important step is simply starting. Because the biggest mistake in investing isn't starting at 30 instead of 20. The biggest mistake is never starting at all. Across the United States, millions of people delay investing because they believe they need more money, more knowledge, or the perfect time. But the truth is simpler. Most successful long-term investors follow very basic principles. They invest consistently, they keep costs low, they focus on long-term growth, and most importantly, they start as early as possible. So if you're in your 20s, the most powerful financial move you can make is simply getting started. Even small contributions can transform your future. And if you're in your 30s, you're still in a fantastic position. The key is to stop waiting and let compounding start working for you. Because when it comes to investing, the real secret isn't picking the perfect stock, it isn't timing the market, and it isn't chasing the latest financial trend. The real secret is surprisingly simple: time. The earlier your money starts working, the harder it works for you. And over decades, that difference can completely change your financial future.